Well, hello there. Today I want to share with you 3 ways that you can build a solid investing foundation. Hello, my name is Jeff Luke. I'm an investor. I'm also an author of books about investing, and I'm a professional photographer. I love to share with you ways to use your imagination to innovate and invent and think about investing in different and useful ways. And I also really love to share ways that you can build a solid investing foundation. It's something I've been doing for years. I think I've learned a few things along the way, and I really like sharing these with you. I want to remind you, I'm not a professional investment advisor. If you need specific advice about what you're doing, I highly recommend you contact a professional. Everything I share with you here is to help with your education. If you like this video, please give it a thumbs up, a like, and also consider subscribing, and that way you'll get a heads up when I make new videos. So, what are these 3 magical things? Well, these 3 pieces of advice that I think will help you build a solid foundation are kind of essential, and I'll start with the first one. And I just want to say before I get started, why do we need foundations? Well, do you know what this is? You may recognize this. This is a level. Some of you have already built things and maybe worked in construction or did some renovations, so you've used one. But for those of you for whom this might be new, it's a level. It's like a metal bar, and it's got 3 little tubes that are filled with liquid, and then they have an air bubble in them. And what you can see here is when this is level, the bubble will be right in the middle between these lines, and then you know that this is perfectly horizontal. And the same goes with making it vertical. You just move this until the bubble's in the middle, and bingo, it's vertical. So why is this important? Well, if you're building a house, you want to know that the foundation is solid and that it is level. You don't want things leaning, because as they lean, all of a sudden everything built on top becomes unstable. Things can kind of tilt and fall, and over time the house or the building can eventually start to deteriorate. Well, I think that when you invest, you really want to build a solid foundation so that everything you do is built on intelligent decisions and not on hopes and dreams and gambling. So the first thing that you need to do to build a solid foundation is you need to understand any stock before you buy it. And I've had people ask me, well, what does that mean, understand? Like, what kind of understanding? Because some people think you have to be amazing at math, or you have to understand balance sheets or profit and loss or cash flow statements and all of this stuff. And they all kind of will help you add to your understanding. Learning about accounting is always helpful for any investor. But when I say understand, I mean you should only invest in a company if you know what it makes or what its services are. It helps if you're a customer of that company, but anything you can do so that you could explain to another person, or like a kid, in 2 or 3 sentences why you want to invest and why it makes sense and why you believe that this company is going to grow for many years into the future. A lot of people make investments where they can't answer that question. They don't even know if this company is going to exist in 10 years, yet they're willing to throw hundreds or thousands of dollars into investing in it. So the first thing is understand. Understand whatever stock you're about to invest in before you buy shares. Now, the other thing you can do to help you build a solid foundation and also to reduce your risk is to invest over time. So if you have, let's say you have a chunk of money, you want to invest it. Rather than putting it all into the market now, you would break it up into pieces, and you would invest some now, and then a part of it, say, in 3 months or 6 months, and then maybe another chunk of it in a year. And by doing this, you reduce the risk that you're going to put all of your money in when the market is high, or in other words, when stocks are expensive. A lot of investing is removing risk whenever you can, figuring out ways to not make mistakes and not lose money. So I highly recommend, just in my own life, when I think of what I'm doing with myself, I tell myself, don't go in too big. Don't take too much of a chance where if things go the other way, you're going to regret it or think, I should have been more careful, or I should have anticipated things going wrong. And I think if you think ahead in that way and spread your investments over time, you can decrease a lot of risk. And I also wanted to say this whole idea to talk about spreading money over time came from an email that I just got. And this email is from somebody who read my book, and they said, hi, just finished the book. It was great. The real world examples you use are awesome. I have a few questions. In several of your books, you said to keep some cash available in order to buy when stocks are cheap. You also said not to buy them all on the same day. Do you have some type of formula? Do you have some type of formula you use when doing that? And the simple answer is no, there's no formula. Nobody knows when is the best time to commit money into the stock market. If anybody knew for sure that the stock market was at an all-time low now, it'd be very easy to know to take all your money and put it in now. And by the same token, if somebody could tell you the stock market is really high right now, everything's too expensive, you would know not to commit any money to it now. But the truth is, nobody knows. And that's a huge truth. Like, if you take one piece of wisdom away from this video, just keep in mind, no matter what people say on TV or what articles you read online, nobody making any prediction about where the market's going knows anything. And that's a really good filter. When people start to tell you where the market is now and where it's going to be in a week or in a year, just realize you can just discount them because nobody knows. That's a really good filter. So there's no formula to answer his question. I think a good rule of thumb is to invest in a way where if you made a commitment of money and bought stocks, no matter what the market did, you would not feel like you were foolish or you did something silly or you went in too much. During the market crash in 2020 that started around end of February and it went into March, I personally started investing when I saw the market had fallen maybe 5% and then 10%, and I just took a small amount of what I had in cash and put it in. The thing is, sometimes when crashes happen, they can last for several months. When I say a crash, sometimes there's a crash and the market goes down 10 or 15 or 20%, and sometimes it just continues for a year or 2 years where the market's declining or it's moving sideways. And as an investor, you're hoping it will recover. But if you spend all of your cash and you invest it early in that process when the markets are going down, you may not have any left when it gets much, much further down, and you might regret not having saved some money to invest when prices and stocks get really cheap. So never knowing when that's going to happen, I would say in my own life, I prefer to make the error on the side of not going and spending all my cash right away, even though that leaves you with the risk that when the markets recover, you're still going to have some cash in your bank account that you didn't buy stocks with. But when I look at possible bad case scenarios, I've never had one where having cash in the bank was something that I regretted. So anyways, keep that in mind. I am maybe more conservative in my approach than some people. You perhaps might be much more inclined to take the risk of sinking more of your money into stocks when you think they've declined enough. But I personally would rather invest a little bit at periods of time and make sure that a year later or 2 years later, I'll still have some money left and that I won't have spent everything early on in a market decline and have nothing left to buy stocks when they get cheap. So one thing I wanted to share with you is a specific example, because I think sometimes we learn better when we have real life examples. A company that I understand, going back to that earlier point, is Amazon. It's just because I I'm a customer. I've been a customer for years. I live in Seattle, and I get to see the company growing, both as an online retailer, but also it's just phenomenal growth in cloud computing. And so I feel as though I have a really good grasp on the power and the stability of that company to last for way beyond the next 10 or 20 or 30 years. I think it's just going to be a solid investment. My understanding of the company tells me that. So then I decided what I think a fair value of that company for one share of stock would be. So for example, a few weeks ago, I decided around $3,500 a share would be a good price. That's a fair price for that stock. When I noticed over the past couple weeks that the stock price started declining, it went down to like 3,200 and 3,100, and then it hit 3,000 a share, and then it went into like the 2,900 range. I just decided, you know what? I think it's worth about $3,500 a share. If I can get this at a good discount to that, then I think it might make some sense to buy shares. And so that's what I did. When it got into the range between 2,900 and 3,000, I bought some shares. But what I wanted to tell you about this is I didn't take all the money that I had in cash and just put it all into that stock, because there's always the chance that something could happen, and something may well happen in the next few months or in the next year to send the stock price even lower. And if I went all in when I went in like last week, I won't have any money left. So I feel as though by making a small investment now and then just waiting, you keep your options open to buy at lower and lower prices without making that mistake of spending all your money now and then just sitting around and waiting and watching and wishing you had some cash left later. So the third item that I want to talk with you about as far as reducing your risk and building a solid foundation is in diversifying. And I know this is used a lot. You hear about diversification all the time. But I'll tell you what it means to me, okay? When I was starting out, I invested in mutual funds. For a number of reasons, it made a lot more sense when I began investing. Now there are index funds and there are ETFs, which can help an investor to diversify across, say, 500 different stocks or 5,000 different stocks just by making one purchase. It takes very little time, and all of a sudden you have a kind of foundation where your money is spread not across one company, but across many different companies and a lot of industries. So personally, I like that as a way to start my investing. And I think now I tend to be more concentrated in the way I invest because I already have a foundation. And so knowing that, that's already been put in place, like building a house, I can work on fine-tuning things and making this room a little nicer, or buying this furniture, or painting the walls, or changing things around, buying some plants or a mirror. Anyways, once everything's solid, you can kind of put accents on it. And I find that investing in stocks is a good way to add accent and concentrate your portfolio on your best ideas. But I know personally, when I started out, I didn't want to take a lot of risk that investing in one company could, hurt if things went the wrong way. So I find that diversifying makes a lot of sense, at least in the early stages. Once you feel more confident and you have more experience, then I think it can make sense to make investments in individual companies. But when you're starting, I think a diversified portfolio makes a lot of sense. Personally, I have made a decision to buy some stocks for my future that are spread across a number of different industries. And the reason I'm doing this is it's an investment portfolio that I'm building, and I'm going to be talking about it in this channel. But my main point is sometimes if you want to reduce risk of any one company in your portfolio, diversifying can make a lot of sense. So just to recap, the first thing you want to do is understand what you're investing in. The second thing to build a solid foundation is to invest over time so you don't go all in at the same time. And the third thing that you might want to consider is just the power and the comfort and confidence you get from diversifying, so you don't have to wonder or worry that any one stock is going to have a bad effect on your portfolio. So I hope this has been useful and helped you to build a solid and level-headed foundation for your investing in the future. If you have any questions, please just type them in the comment section. I'm going to be checking comments and I will respond to them whenever I can. If you like this video, again, please click the like button, and also remember to subscribe, because I'm going to be going into depth and talking about specific stocks in the next few weeks. And if you're an investor and you want to learn a little bit more about how someone with experience approaches making decisions, I think that you might really like following along with some of my investment ideas. Thank you so much for watching. I hope this was helpful, and I'll see you next time.